Katika dhamira yetu ya kukuza ubora na taalamu katika tasnia ya fedha tunasimama katika dira yetu ya kuwa taasisi inayoongoza kwa wataalamu wa uwekezaji na fedha. Tunasimama with integrity and competence, innovation and fairness, and accountability. Huku wanachama wetu wakiongoza kwa ubora zaidi katika tasnia ya fedha. Ni wakati wa sifa kwa wanasifa, to shine. Ni wakati wa sifa kwa wanasifa, we shine, we shine.
Hello everyone, good evening. Welcome to our webinar. For today is the topic regarding to guiding to investment taxation in Kenya. Today we are grateful to join by one of our experts called FA Joseph Kinuthia. He'll be able to take you through, and you are most welcome. And as we proceed, we are kindly requesting that you just type in your questions, and because today our webinar will just run for only just 1 hour. So keep your question coming as we proceed. So I'll take this opportunity to welcome FA Joseph Kinuthia. Take us through.
Thank you, FA Collins, and thank you for that introduction. Yeah, we are going to look into the taxation of various investment instruments in Kenya. And I have a presentation which I will share with all of us. So let me open it, then we can proceed from there. So welcome everyone on board, and today we are going to look into the investment taxation in Kenya. And as the saying goes, the taxation is one of the sure things that will happen to all of us, because if and whenever you go to buy something in the shop, whatever income that you earn as an individual or as an institution or as a company, that income will have a tax element. And therefore, very important to look into the taxation treatment of the investment, so that you're able to derive at the correct return. Because if then taxation is not brought into board when you are doing your financial analysis, or whenever you are looking into various investments, then it means that there is one portion that has not been incorporated into either the model or even in the decision-making process. So taxation is critical, and I want to thank the ICIFA for bringing this topic because it's critical for all of us. And to start with is that taxation for investment or on investment is not just the, let's say, the withholding tax or any other direct taxation that is levied on a specific investment or instrument, but rather is the entire bouquet of taxes. Because, for example, if I may bring something that it was in the public a few months and even years ago, is a certain, I don't know to state the names of the entities, but if you search in the website, you'll be able to see that. There was one of the companies, a leading investment company, that had a private equity, and this private equity was to be disposed to a third party. So what happened is that since that company where the private equity was placed had some tax questions. And so what happened is that when the sale of the portion of the equity was being done, there was an agreement that the tax question or the tax dispute that was active at that time, the company will need to put aside some money so that if KRA wins, then they will be able to pay for that tax. And that tax was excise duty and VAT. So I'm bringing that into perspective so that then in our discussions, we are open to all taxes, because each and every tax has an effect in the investment or in the company or even in the individual. And therefore, in our discussion, we will look into all the taxes, and you are free to ask question in the chat. Just whatever question at whatever time, just type it, and then we'll be able to look into them at the tail end of this presentation. It's a short presentation, as Colin has said. We only have 1 hour, but I believe we'll be able to use that hour to the maximum. So let me proceed to the presentation, and we'll start with the table of content. Table of content, we have a lot of things, but we are not covering all these today. So today maybe we'll be able to cover the first 2 or 3 items, and then from there we'll be able then to see how the rest can be covered probably in future. And therefore then I will start with the first one is the introduction of taxation. This is where we look at the general tax landscape. We will go to tax administration and technology, and then the Finance Act 2022. That's the recent tax changes, which I believe we'll be able to cover today. And then there will be voluntary tax disclosure program. So we'll cover the first 4 items if time allows us. And then in our next session, we'll be able then to cover the rest as time goes by. So that's the table of content. There is also a continuation of the table of content there, where there is VAT and all those, and tax diligence, tax health check, selected sectorial taxation. Probably I want to mention the last one, and the last one we would request you, when we talk of selected sectorial taxation, is that every sector, be it money market, be it life insurance, all of them, investment in real estate, manufacturing, each has a specific or salient characteristics. And therefore, it's something we want to look into maybe in future. And therefore, we would request you that maybe you propose in the charts the area that maybe in future, or the sector in future that we may look into, because each sector has its salient features, and maybe then in future that can be considered from what you'll have shared with us. So that's the tax system. As I'd said, there are many taxes, and for this, even if we are talking of investment taxation, we are going to look holistically into them, because as I started, by and large, I've connected to another router. So thank you. And as we have said, this is where we were, the taxes that apply in Kenya. And we will not dwell, so to proceed to the next slide. Yeah, so the next slide is still on introduction, and I don't want to belabor on this. We all know all this about the tax administration, the treasury, and the KRA. So we'll proceed to the next. And maybe here I can mention there are 2 kinds of taxes, direct and indirect. Direct are the taxes that are charged on the income of an individual or corporate, and indirect are the taxes that are charged on the goods or services that are consumed. And therefore, then you may not directly feel these taxes, but they are there. And so I want to mention that. And so that was the introduction. I didn't want to spend so much time on that. So the next point we are going to discuss is on tax administration and technology. And here is where, as we all know, KRA is really advancing on technology, deploying technology. And out of this, I only want to mention about the last, number 4, which is tax invoice management system, which was launched last year. And this is where now all taxpayers who have VAT liability are required to have a GPRS enabled ETR or ESD machine. And the deadline for this was July 31st, but KRA extended it to 30th September. So just to remind you that 30th September is fast approaching, and therefore the need to deploy or to get the GPRS enabled ETR or ESD. Because if failure to get this, there are various penalties to it, and any penalty or any amount that goes out of business is unwelcome, since the return and from that investment is proportionally reduced. So just take note of that, teams, and the deadline is coming to is on 30th of December. And so this one is just an illustration of how it operates, so I will not go into that. I just want now to get into the Finance Act 2022. The reason I have put this as item that we'll discuss today is because these were recently enacted, and therefore many people may not be aware of the requirements under the Finance Act of 2022, and therefore the need just to touch on what the new act or the Act provide. Finance Act amend various tax laws, which include Income Tax, VAT, Excise Duty Act, Stamp Duty Act, and all those. So it comes as a bouquet, just as a one act, but amends various acts of parliament that administer taxation. So on the first item, the introduction shows how it was enacted and when it will come into effect. So I only want to mention a few. As you are aware, the Act is usually a big document with many provisions, but for the purpose of this webinar and this discussion, I've only mentioned a few that I believe has a direct impact, especially on the investments field. So number 1 is the increase in capital gains tax. Previously, the income tax, the CGT was at 5%. So with effect from January, it will be 15%. So and also important to say is that still there is no indexation. Indexation is whereby is where the element of inflation is an element of inflation is eliminated, and in progressive economies, there is always indexation, because whenever you apply a capital gains tax on an item that maybe was bought in 1980, and let's say it was bought at 100,000, and right now it's at, let's say, 5 million, you apply the CGT on the difference, it essentially means that you are even charging tax on inflation. And what usually happens, and this is one of the items we had hoped that would be adopted, and maybe something then can be lobbied, is the use of a consumer price index, because this even in other countries that's what happened, such that an element of inflation is eliminated. For example, if the consumer price index CPI in 1980, for argument's sake, was 100, and currently it's 1,000, then that element, and it was bought, let's say, for 100,000, then that amount is uplifted, let's say, to 1 million, because it will be 100,000 times 1,000 divided by 100. So the cost, then the life would be 1 million. So if you sell at, let's say, 5 million, then the actual gain there is 4 million, not 4.9. And therefore, it would be 4.4 million. That would be a charged CGT rather than 4.9, whenever indexation is applied. But in Kenya, as it is now, the indexation is not there, and therefore it's the initial costs minus initial cost plus all the incidental costs, the cost that you incur when buying, and also the cost that you incur when selling. Then the profit, whatever remains, become the amount that is chargeable to capital gains tax. And as I said, the amount now, the rate is 15%. It's no longer 5%. So that also now has an effect in terms of the erosion of the investment return, since a 15% will go. So when now making the assessment of a various investment, it's therefore important then to factor this in, because this is a cash outflow going to the revenue authority. Also, a new development which has not been there in the Income Tax Act is on the gains on financial derivatives, and except for those that are listed in the stock market. So whatever forward swap contracts that are there with a non-resident, and then there is a realization of a gain. Let's say you had there was a contract where a non-resident make a gain out of it, then it become then the company paying that has a responsibility to withhold 15%. So this was not there, and the effective date is January 1st of January 2023. And therefore, then for those people who are in that field, or those who are hedging some of their products, then it's important for you to take note of this new development, that any gain that accrue to a non-resident is subject to a withholding tax of 15%, and the payer then is responsible for that withholding. That's important. There is also another new development through the Finance Act of 2020 is what we are calling special operating framework arrangement. So the proposal, what this means is that for companies that get into this special arrangement with the government, then the arrangement will prescribe a certain rate, and this is mostly on the production or manufacturing of human vaccine. So what then is proposed here is that any company that then want to venture into this area and has an investment of about 10 billion, then can negotiate with the government and then agree on the tax rate. So this tax rate, the maximum rate now is 30%. So anything between 0 and 30, depending on how the arrangement is, then that entity will be charged that specified rate. So it's an important, because if any of your entity is considering, then this is important then to know that there is that tax concession, and therefore then maybe they look also maybe even a prospect of a higher return because of that tax rebates or tax concession. So that's important. There is also some of the income that have been exempted. There's some showing there down. And this time, what is clear is that the government has been looking into the area of manufacturing of human vaccination, maybe because of the trigger of the COVID-19 and the need then to build the local capacity, and also then because of the projects that had already been started, especially to manufacture COVID-19 vaccination, and therefore then the need to give this concession to enable the companies that are in this to be able to operate, and maybe also to be able to get some external or internal funding because of a prospect of a higher return. So this is also an area that you can take note of. Another one I want to highlight is about having or starting the manufacturing entities outside Nairobi and Mombasa County. And so the act or the law now allows someone who starts this kind of an investment to get 150% investment deduction. This means that if, let's say, you have provided the investment is 2 billion. So this means that if the investment is 2 billion, then you are able to claim a 3 billion investment deduction. And that then gives some advantages, because the 300, if you are not even able to recoup in the current year, then those losses can be rolled forward and be able to get that action in future. So this is also important when considering the location of a manufacturing farm. So that's important. The other one I want, the other entities that are getting some concession are those that are dealing with the carbon market exchange and all that, and the shipping. They're getting a lower rate of 15% for the first 10 years. So that is important to note, because then with that lower rate, it directly translates into a higher return, because then a portion that may have gone to taxation then become part of the amount that can be distributed to the various stakeholders, be it the shareholders or debt holders. So on the other side, I want to just mention one thing on the VAT, which I believe is important, because as a practice for all the exported services, the general practice or the best practice is that export of services are zero rated. And that's what happens to most, if not most, of the jurisdiction that has a VAT. But then what happened with the Finance Act of 2022, it started with the Finance Act of 2021, where the export of taxable services were removed from zero rated and they were taken to exempt. That has a significance, because if an item is exempted, then it means that you are not able to get the corresponding input VAT deduction. So they were taken to exempt, and now with the Finance Act of 2022, they were deleted from exempt, that export of taxable services. And taxable services, if I may give an example, maybe you are giving a service to an entity that is based, let's say, in Uganda or any other country outside Kenya, and therefore it's that country that pays you. So it means if you are rendering a service to an entity outside Kenya, it means then that you are exporting that service. And so those services used to be zero rated, then they became exempt. And with this act, they were deleted from exempted, and they were taken back to exempted, but with a rider. And the rider is that exportation of taxable services in respect to business process outsourcing. So if your business is not, if your business is not into this business of business process outsourcing, then it therefore means that service goes to taxable at 16%. So that's an area that I believe more clarification will come, maybe in terms of guidance by either KRA or the ministry. And I foresee a lot of maybe a lot of dispute around this because imported services, if you import a service from Kenya, it will become a taxable, a VATable services within Kenya. And therefore, and also, and now, even when now you export a service that is not a business processing outsourcing, then there is also that requirement for you to charge another a VAT. And therefore, then with that arrangement, the businesses in Kenya are disadvantaged, especially those that have inter-border transactions. Because then there are likelihood that you are paying VAT on import side service, and also you are paying VAT on exported service. So that has never happened again, and so that's why I'm saying we are expecting, or we are foreseeing maybe disputes are arising out of this, and maybe then having a court of law pronouncing the correct position. In the past, there have been a lot of cases, quite a number of cases in the tribunal and others in the court, and those one were now about whether an item is or a service is exported or not. So that was the past question, but now I believe now the next frontier of dispute is expected to be the providers arguing that this service is not consumed in Kenya, and VAT being a consumption tax, then there will be a need for interpretation as to whether any of an exported services would be subjected to VAT at 16%. So those are the main items I picked from the Finance Act, and I felt it's important that I discuss with you. I know I have 10 minutes because the rest of 15-20 minutes will be for questions and answers, but I also want to touch on voluntary tax disclosure program. So this is a program by KRA whereby people who have not declared full taxes have been given a chance to declare and have remission of penalties and interest. So if there is in your business, in your personal level, if there's some income that you have not disclosed, then this voluntary disclosure program gives an opportunity for you to make that declaration with minimum penalties and interest. So the program started in January 2021 last year, and for people who made declaration in 2021, they were enjoying 100% remission of penalties and interest. So if your tax was, let's say it was 100,000, then you would make a declaration, you pay 100,000, and that's all. And there will be no penalties and interest. That was 2021. That's why I've highlighted it red, because we already passed that. So the 2021 is gone. We are now in 2022, and the 2022 is giving a 50% remission, or call it waiver of penalties and interest. So if I use the same example, the tax is 100, let's say penalty is 20 and interest is 10,000 for illustration, for illustration's sake, then it means that you now have to pay half of penalty and half of interest. And if the declaration happened in 2023, you only get a quarter of the penalty and interest. So And this covers taxes that were due between 1st of July 2015 and 30th of June 2020. So, and it covers all those taxes that are put there, or all the domestic taxes. So if there is any amount of tax that you may wish to, or your firm, or as an individual you may wish to declare, then there is the chance is still open, but now at a reduced remission. Rather than the entire 100%, the amount now is lower, up to half of 50%. So, and just to make a distinction, the voluntary tax program usually comes once per every 10 years, because the last one I remember was around 2010 there. So this one has come around 2020, 2021, which means it's a 10-year period. So there is the general waiver that we all know there is still there, but currently you are not guaranteed that if you apply for a waiver, you'll get it. And therefore this is a good opportunity to look at whether then you can make this declaration, so that then the business does not continue carrying this risk of penalties and interest. So the taxes covered are those ones, and this now has been fully automated into iTax. And like in the beginning, when in 2021, it was not very clear how the application is. So we used to do it manually, and a time allowed July there, we were told to redo them again in iTax. But right now it's fully automated. It has a certain procedure that you follow for you to make that declaration. So it's something you can consider, so that the business does not continue carrying so much risk. And in as much as then the business has the risk, it therefore means that even the valuation of that company would be affected by that tax, by that pending tax liability. And that's why whenever we are making any investment decision, one of the important exercise is to do a due diligence, a tax due diligence, and then you are able to look into all the transactions of the businesses and determine then whether that company is carrying an additional risk, which then need to be provided for, to come up then with the correct investment value. So I want to pause at that point and maybe welcome any question from your end, and maybe also hand over to Collins to coordinate from there. Thank you very much. So I can see there are questions here. From Edwin Gitaka, is the CGT change from January applicable to us asset? Collins, you want to take over?
Okay. Thanks a lot, FA Joseph, for wonderful presentation. And today has been an interesting day, especially to understand the impact of tax in our investments. So, General, I have one question that I want to just make a clarifications regarding to capital gain tax. You see, what happened, we just want to know regarding to capital gain tax. Is it after realized or unrealized?
Yeah, thank you, Collins.
Yes.
Yeah, for capital gains tax, capital gains tax is on capital items. And I want also to bring a distinction here, that an item can be a capital for one entity and not a capital for another. Let me give an illustration. For a company that is in real estate, you'll buy land, you'll build houses and sell them. So that is business. So that's not capital gain. So when you sell a house or you sell land, that being your principal business, that's not a capital gain. But for an entity that has one property that is not actively traded, and that property is sold, let's say an entity in consultancy, for example, it has a plot of land somewhere or a building, and then that building is sold, then that building will form the tax on it is capital gains, not business tax, not corporate tax. So so to answer that question is to determine which item will follow under the capital gains tax, there is the need then to look into the industry in which the person or the company is operating in, and therefore, as I have just demonstrated. But there are those items that are outrightly exempted. For example, the listed stock. The listed stock, that one will not have the capital gains tax because it's already exempted. So just to make that clarification, for you to fully determine what a capital gain tax, there's need to look into the industry, and then there is need also to look into those items that are expressly exempted from CGT. Thank you.
Okay, many thanks for the clarifications. So there is a question from FA Edwin Pitaka. Just want to know the capital gain tax, whether it changed from January 2023, applicable for all asset class such as property and financial assets.
Yeah, thank you, Edwin. As I've said, the CGT will apply to those to the capital assets, not the revenue assets. And the capital assets are determined by the industry in which that asset is, where that asset is being traded. For example, as I've said, the property, if you are in real estate, that property is not under capital gain. It is under the normal, that's a business. So it will be under, you'll have to get it to have sales, costs and all that, then the profit you subjected to that percent, assuming it's a company. So the property would be subject to CGT if it's a one-off, and that's not the principal business of that entity or that individual. Thank you.
Okay, thanks a lot, FA Joseph. Okay, I've seen FA Robert Ochieno has raised his hand. So,
yes, Collins, you can continue.
Yes, FA Robert Ochieno.
By mistake.
Okay, you also have FA Kamau Kimari.
Hello.
Yes. Yes, FA Kamau.
Yes. Now my question is on the part of the remission. What if, for example, a company had already paid the total tax payable plus the interest thereof, and then there is this now change that has come where you're supposed to get 100% remission? Will KRA refund you back, or what happens then?
Well, thanks a lot, FA Kamau, for your question. So I think this is a little bit drop to our specialist.
Yeah, thank you, FA Kamau. That's a good question. Unfortunately, since you have already paid that tax, it therefore means it's not undisclosed. You have already disclosed it, therefore not then entitled to the waiver provided under FTDP. But you can still make an application, and you have also said you have already paid interest. So in this case, then, since you have paid the principal and the interest, that cannot be opened, and therefore then you cannot enjoy the voluntary disclosure program, neither the general waiver.
Okay, thanks a lot, FA Joseph Kinuthia. I think it's clear. Kamau. So there's also another question which has been raised by FA Lucy Maina. She just wants you to be able to expound much on regarding to taxation on derivative instruments.
Yeah, as I mentioned, thank you, Corinne. As I mentioned, this is a new tax. It has never been there in the history of income tax in Kenya. And therefore, we are waiting to see the guidelines, because then there is expectation, and they will provide that the ministry will provide guidelines on how the taxation of derivatives will be done. But as a general comment, from what the law prof has provided, is that any contract or any future or options, or all those forward contracts that a company enters into with a non-resident. So the key point here is that with a non-resident, a person not residing in Kenya, and out of that contract, there is a gain to the person outside Kenya. So that gain then is a taxable income in Kenya at the rate of 15%. So unless that derivative is listed. So for the listed derivatives, there is no withholding tax at 15%. But for those that are not listed, then the 15% applies. So that's a general taxation. But then we expect that by the time this is coming into effect in January, we would have guidelines that will help in determining how this will be administered. But that's a general provision of the law.
Oh, that's nice. I think that's clear to FA Lucy Maina. And we also have FA Benson Wafula. We just want to know whether we have environmental climate tax that exists in our country.
Environmental, from the Finance Act of 2022, it has tried to bring that by the green energy. For the companies that are in the green energy sector, they are entitled to a lower rate of 15%. So the general rate is 30% for taxes in Kenya. But for those that are in that industry, then the carbon trading, then though, and I believe that's the environment sector that the FA is referring to, then there is that reduced rate of tax at 15%. So it was just introduced with this Finance Act of 2022.
Oh, thanks a lot, FA Joseph Kinuthia. And okay. We also have one of our members called FA Peter Koech. He's just asking, is corporate tax applicable for individual real estate developer who are not registered in the industry regulators?
Yes, FA Peter. The CGT actually looks into the that investment, regardless of whether you are registered within that industry or not. So provided you are dealing with the items that has a capital gains tax element, then it will apply whether you are registered or not. Here I see 2 points what they're commenting about. is talking about individual real estate developers. So that alone almost then removes this individual from CGT, because as I said, capital gains tax applies where the sale of that item is not as a way of business. A good example is the real estate. When somebody is in real estate, they are buying land, they are building, so those buildings are sold. So those ones will not have a capital gains tax because that's a way of trade. So that person will be the taxation for the real estate for someone in real estate will be when you sell land or you sell the property, that become revenue for the business. So then you minus all the expenses and all the deductions that are there, and you come now to the taxable profit. That taxable profit is charged at 30%. So when you are frequently trading with what you may call capital item, that's no longer that's a way of your business, and therefore not under the CGT regime. CGT regime will kick in wherever is a one-off sale. The example that I had given, let's say somebody in hardware or has a land somewhere or has a property, then they sell it off. That then will be under CGT because it's not a frequently traded. And this matter has been, there has been a dispute around it, and it has gone to the court, and that's how the court has ruled. So that one is supported by both the legislation and also the case law. Collins, you have muted. We have FA Kamau who has a question.
Yes. FA Kamau.
Hello.
Yes.
Yes, Collins. Now, on the same.
Yes.
Let's say, for example, a company has foreign back in terms of paying taxes to KRA. What I mean is, for example, they have not paid taxes for a while, and then at some point, KRA attaches, for example, their bank account and takes some money from there towards paying the taxes. So my question is, at the point when that company now files the returns and wants to pay taxes, should that money be considered in the reduction now of the total tax payable for a company? Thanks.
That's a good question. So if Joseph can able to answer that question.
Yeah, thank you, Collins. Yeah, I've got the question from FA Kamau. He's asking where the monies have been attached. We call it agency notice. What KRA does, if there is any liability, they can issue a notice to either the bank or the other debtors, so that instead of paying to the person, that money is paid directly to KRA. So if that then has happened, the context of FA Kamau is for a non-resident payment, where he's asking whether that amount can be a deduction to the company's taxes. So the way withholding tax works is that is a tax on the payee. So if you are paying someone who have led a due service, For example, if somebody is come from Uganda or Sudan, and then you are paying a fee, you are supposed to pay them less, assuming that where there is no, assuming there is no double tax treaty. It's 20%. You are paying him 20 million. So you are supposed, a million. You're supposed then to deduct 20% of that. That's 200, and pay to KRA, and the 800 you pay now to the supplier, to the payee. So what happens if then you don't withhold and you pay this person a whole million? Then the 200 would be demanded from the payer, though that tax was not his tax. Then automatically then the payer get hit by that amount that was not withheld, which then will have to go to the profit and loss as a compliance cost, and therefore reduce the profit of the entity. That's number one. And then number two, since there's a compliance penalty, is not a tax deductible. So what will happen now in the tax computations, when doing the tax computations, it's an add back, such that if at all there was no any other add back, your net profit that you have to add that 200 and charge, and now come to a taxable profit and charge that amount now to tax. So just to answer FA Kamau, once that has been flagged out and has been paid either by you or through the agency notice, then there is no reprieve. There is no, there will be no remission, and that the business incurs as an additional cost, and therefore then the need to, and maybe even the penalties and interest, because then there will be penalties and interest on that, which also now be charged to the business or to the individual, and therefore then the need to be very vigilant on the tax matters, so that then you are not caught on that side of the law, since you'll have limited. Thank you.
Many thanks, FA Joseph, for your wonderful presentation. Things has been taken away.
Kamau, you have a follow-up question, Collins?
Hello?
Yes, can continue?
Yes, thanks for the explanation. If I got you right, what you're saying is the money that has been attached then becomes a loss to the company. Is it so?
Yes.
Thank you. All right.
Yes.
Thanks a lot, Joseph, for the presentation. Today you have learned a lot about investment, because regarding to tax and investment, because it's one of the components to consider, especially when you're engaging with investments. And since we don't have any questions, you can give us your few remarks. Yeah, and we see at where you're going to end.
Thank you, FA Collins. Mine is to thank all of you for attending and for your questions. And I believe we'll continue having this discussion. As we had said in the table of content, we have quite a number of areas that we would like to look into. And maybe then in future, we'll see whether we can have another session where we can have this discussion. So let the discussion continue. If you have any query, if you have any question, you can channel it directly to ICIFA. We'll forward for further clarification. Otherwise, thank you very much and have a nice evening.
Thank you.
Thanks a lot, FA.
Thank you,
Joseph. And just for the reminders that next month on 8th, we shall be having our webinar regarding to building a successful wealth management strategy. I'm looking forward to see you. Thanks a lot and enjoy your evening.
Thank you. Goodbye.
Bye.
Katika dhamira yetu ya kukuza ubora na taalamu katika tasnia ya fedha, tunasimama katika dira yetu ya kuwa taasisi inayoongoza kwa wataalamu wa uwekezaji na fedha. Tunasimama integrity and competence, innovation and fairness, and accountability.